All right, welcome to Learning Objective 2 here, in which we're going to be introducing you to something called a high-low method. Okay. Um, and basically it's a method that we look at the total costs that are going to be incurred at high levels of activity and low levels of activity. And it's going to help us, as you see here, classify our mixed costs into what part of that mixed cost is the variable component and what part is the fixed component. Okay, so that's basically what this allows us to do. It's very interesting, I think. Hopefully you will too. So here we have a few steps. The very first step in our process is to determine what's the variable cost per unit. Okay. And so we look at the change in the total cost. Now, if you have your book, this is on the top of page 189. We take a look at the change in the total costs of what we just did, and we divide it by something called the high minus low activity level. And we get what's called the variable cost per unit. So you're gonna learn how to do this right now. Okay, so this is how we use the high-low method to determine that. So we have this company here, Metro Transit Company. And they have the following maintenance costs and mileage data for the last 6 months: January, February, March, April, May, and June. Okay. So what we have to do with the high-low method is, again, what month was the highest amount of cost and mileage, and what month was the lowest? And that's how we're going to find the difference. So if you look here for April, they had the highest number of miles, 50,000 miles is the biggest number here, and the highest cost, $63,000, is the highest cost of all the numbers listed here. So April is the high. January is the low. Why is it low? Because it has the least amount of miles driven in all the 6 months, is 20,000. And then the total cost is also the lowest, 30,000. So now that we've identified the high and the low, we'll look at the changes. So the total cost in April was 63,000. That's the highest. The lowest cost was in January at 30,000. The difference is 33,000. The high amount of miles is 50,000 in April. The lowest was 20,000 in January. The difference is 30,000. And so basically, you can look at this as having $1.10 cost per unit using the high-low method. So that's the first step you got to do. Okay, that's a good one. This is explained also on page 189. It's a very good explanation. Okay, and you'll be doing this. So the second step here, and again, it's step by step, as most of you know. We're going to determine the fixed costs by subtracting the variable cost, total variable cost, at either the high or the low activity from the total cost at that activity. So here is the activity level for the high end, which was in April, I believe, right? 63,000 was the total cost on the high end, which was April. Now we subtract out our variable costs. We had 50,000 miles in April at $1.10 per mile. That's $55,000. So our total fixed cost would be the difference. If it's true for the high end, it's true for the low end as well. $30,000 was the total costs. We subtract out the 20,000 miles at $1.10 per mile of 22,000, and lo and behold, total fixed cost match. Okay, 8,000. So now we know basically what the fixed cost is by subtracting out the total cost minus those variable costs that we did in step one. Yay. So maintenance costs would be $8,000 per month of fixed costs plus $1.10 per mile in variable costs. So this would be the formula that comes out of that. $8,000 is our fixed costs. We're going to add to it $1.10 of variable cost times the number of miles that were driven. So the example is, what would be the total if 45,000 miles were driven? Okay. Well, we already know the fixed cost is $8,000. That's not going to change. But the 45,000 miles that are driven now are going to be multiplied by $1.10 to give us the variable cost, 49,500. Together, we have a total cost of $57,500 using the high-low method. Okay. So this is just the data for that same company, Metro Transit Company, with the miles and the cost. And as you see, it's relatively linear. It's not perfectly linear, but it's relatively linear. Okay. So again, a mixed cost is what? It consists of a variable cost element and a fixed cost element. And the high-low method allows us to break that down and know which one it is. All right. This story is actually pretty nice as well, and worth sort of looking at here. So one thing that was interesting, and this is when they talk about the last recession, they're talking about not the one that's happening right now, but the very last one we had, which, believe it or not, was almost 11 years ago, 2009, 2008, 2009. So one thing about recessions is we tend to see really dramatic losses in business activity and jobs and so forth. But this here said that one surprise was that for some manufacturers, the number of jobs lost was actually lower. Why was that? Well, because during the preceding years, many companies adopted lean management practices. And so that meant that a couple of things, actually. They were automating. There's a continuing trend in automation in manufacturing. So more and more of the tasks are done by robots or on an automated line, and there's a little less reliance on certain labor groups, particularly on low-skilled workers that are used to be on the assembly lines by the thousands. Now all they really need is a few highly skilled workers who are adept at understanding robotics and computer-aided manufacturing and this type of thing. Okay. So basically speaking, because they relied more on machines and these highly skilled workers, they didn't have to lay off very many of them. Okay. If at all. And so as a result, a single employee supports more sales revenue. And that's important. That's very important. You want to support more sales revenue because you're more valuable to that company. Okay. So it requires a very, very, very large reduction in sales before an employee would need to get laid off. Okay. Plus, if you're a highly skilled worker, you're rare, and employers don't want to lose you. They would rather cut your hours than cut your job. And so that's also what happened. So instead of laying people off, in these cases, reduction of hours were a good option rather than losing the employee totally. But that's part of that lean manufacturing type of thing that we've learned about, talked about a little bit in Just in Time the other day. So it's interesting. All right, so here's the do it exercise about the high-low method. There's this company, Burns Company. They have the following data concerning mixed costs for units produced at each activity level. So here's their period of time: March, April, May, June, and July, the number of units that have been produced, and the total cost. So again, in order to do the high-low method, we have to look at the data and pick the high and the low. And so as you see, March looks like it's a high. It's a 9,800 units is the highest amount of units produced. 14,740 is the highest cost. So it looks like March is going to be your high. Your low looks to be like May. Okay. May has only 7,000 units. That's the smallest number of units here. So that's your low. And 11,100 is your lowest total cost. So now you know your costs and your units. Okay. So now we can actually compute those elements using the high-low method. Once we do that, then we can estimate the cost of the company if it produces just 8,000 units. So again, here we have the high-low method where we're going to be using March's data and May's data, right? We need both the cost and the units. Costs go first, units go second. And so in this case, we have 14,740 of costs minus $11,100 in costs. And then we divide that by the difference in units, 9,800 units minus 7,000 units. And it comes out to $1.30 per unit. Okay. So again, this is March cost minus May cost. And then March units minus May units. It's because we have the high and the low. So in the case of your fixed costs for March, okay, you had total costs of 14,740 to produce 9,800 units. Okay. Well, you know that each unit has variable cost now of $1.30. So you have 9,800 units that you did in March at $1.30. That's your $12,740. That is your fixed cost. I'm sorry, that's your variable cost. This is your variable cost. So you take your total cost, which is the 14,740, subtract out your variable, and that leaves you with a $2,000 fixed cost. $2,000 fixed cost. If you did the same thing for May, it would be the same. Okay. And actually, they do it for May. So here in May, we produced 7,000 units. We know the variable cost is $1.30 for each of those 7,000. So we have $9,100 in variable costs. We have $11,100 in total costs. So your fixed cost is $2,000. So we know for sure the fixed cost is $2,000, and the variable cost is $1.30 per unit. So if they did produce 8,000 units, right, it would be the fixed cost plus the variable. So we have that $2,000, which is your fixed cost, period. And then you have 8,000 units at $1.30 per unit, variable cost, 10,400. Adding those together, your total cost to produce 8,000 units was $12,400. Okay, and that is your high-low method in a nutshell.